Do dividends matter? And can they help you get rich? That's the subject of today's conversation. By the end of the video, you'll understand better where dividends fit into your portfolio as an investor. And if you stick around to the end, I'll show you some tools that can help you screen for and evaluate dividend ETFs. And I'll show you one dividend ETF that looks pretty interesting right now. So let's dive in. The market is really uncertain right now, probably about as uncertain as it's been in a very long time. For context, as of today, early February, the S&P 500 is at 4,100, and it's got a yield of about 1.7%. That's a dividend yield of 1.7%. Let's look at what some of the major stock market strategists have to say. One well-known strategist is named David Rosenberg. He's been around for quite a long time, and he thinks that the market could fall 30% from where we are right now. That would bring the S&P 500 down to about 2,900. The number one rated strategist, according to the annual Institutional Investor Survey, is Mike Wilson of Morgan Stanley. And Mike thinks the S&P 500 could fall to 3,000. On the other hand, one of the biggest bulls on Wall Street is Tom Lee of Fundstrat. Tom thinks the market could actually rally from here to 4,750. So as an investor, how do you make sense of that? Tom, 4,750, Mike Wilson, David Rosenberg, all the way down to 2,900 or 3,000. So what do we do as investors? The number one rule in investing is don't lose money. The number two rule is don't forget rule number one. A better way to think of this is really not don't lose money, but avoid a permanent loss of capital. A permanent loss of capital is where you lose it and you're not going to get it back from that investment. You have to make it up somewhere else. That's where dividends come into the equation. If you buy a stock that has a nice dividend yield and the stock goes down 20 or 30%, as long as they keep paying out that dividend, if you choose to hold on to the stock, over time, the dividend will make up for the money that you lost from the capital loss. So dividends add an important element to a portfolio in helping you to avoid that permanent loss of capital. Now let's think for a moment, what are dividends? As an investor, you can get a capital gain or loss. The stock you bought goes up or it goes down. Or you can get a return of capital from the company. That's where the company has earned money, now has more cash than they need, and they give it back to shareholders. This return of capital can come in two forms. One is a share buyback. The company has extra cash, probably not on an ongoing basis. They just, for whatever reason, have accumulated some extra cash. They want to return it to shareholders, so they elect to buy back shares from shareholders. The other is dividends. If a company has extra cash and believes they will continue to earn more than they need to reinvest in the business each year on an ongoing basis, they can choose to initiate a dividend. The market will anticipate the future stream of dividends, and that will become part of how the stock is valued. So once a company initiates a dividend, they really don't want to have to reduce the dividend or cut the dividend. The company, therefore, initiates a dividend only when they have a strong belief that they can continue to pay it ongoing into the future. So as an investor, buying a stock that has a dividend gives us the security of knowing that we're going to get that cash payment, most likely, nothing's for sure, just on into the future. So that is part of our income stream. So if we buy a stock that has a dividend versus a stock that does not have a dividend, the stock that does not have a dividend, its value is 100% dependent on how earnings grow in the future because they're not returning cash to you. Whereas a company that's paying a dividend is going to be valued based on both the cash payment that investors are receiving each period, plus the future stream of earnings that the company can generate and grow. Now, a quick detour to talk about something called the Sharpe ratio. A Sharpe ratio is a way of evaluating the return on an investment compared to the amount of risk that that investment has. And risk in this case is exemplified by the variation in the investment value over time. So don't get hung up in the math, but basically what you're doing is you're saying, what's the return on this investment? Say it's 10% per period. And what is an alternative risk-free investment? Maybe it's a treasury, a 10-year treasury, for example. And maybe at the time you're doing the analysis, the 10-year treasury is returning 4%. So I could buy an equity that might get me 10% per year, or I can buy a treasury that'll get me 4% per year. So the equity is getting 6% higher than the treasury. So that's the extra return. But an equity will vary more across time. The value goes up and down and up and down more than the treasury will. So it's got an extra expected return, but it also varies more than the treasury. So what the Sharpe ratio is doing is attempting to be a measure of how much the extra return compares to the extra risk. So you get just a numerical value. And so when you're comparing different investments, you're looking at the Sharpe ratio of different investments. So you may have different reasons to pick one investment over another, but just purely on the basis of extra return relative to the risk, you can see which investment has a higher Sharpe ratio, which investment is giving you more return per unit of risk than the other investments you're looking at. So that might be one of the factors you weigh when determining, do I want to buy a certain investment or some other investment? And you can look at a Sharpe ratio for a stock or for a whole portfolio. So I wanted you to understand Sharpe ratio because it'll come up in a few minutes as we look at some other things. Okay, so now let's get into the meat of it. I found a great article that I will link to in the description, written by Hartford Funds, based on work that they did with Wellington Management and some other groups. So we're gonna look at a couple slides here with some of the key takeaways from it. The first one, what they did here is they divided the S&P 500 into 5 groups called quintiles, meaning 5, of 100 stocks each. The first quintile contained the 100 stocks with the highest dividend yield. The second contained the 100 stocks with the next highest level. The third with the next highest level, etc. Then what they did is they compared these over 10-year periods to the S&P 500 to see how they performed in terms of return over the 10-year periods. What they found was that the quintile that had the highest performance, meaning it outperformed the S&P 500 in the most number of those 10-year periods, was actually the second quintile. The second quintile outperformed the S&P 500 index in 7 out of the 10 periods. So that's very interesting. The first quintile, those with the highest dividend yields, did well, but not as well as the second quintile. And likewise, the third quintile also did well, but not quite as well as the second quintile. So why would it be, thinking about it logically, why would not the highest dividend yielding stocks, but maybe the second highest yielding group of stocks perform the best? Well, the ones with the highest yield have such a high yield, some of them, not all of them, but some of them, that it may not be sustainable. So going back to what we were saying before, if a company is valued in part based on a dividend yield and investors are expecting to keep getting that dividend over time, what's going to happen to the value of the stock if the company cuts the dividend? They realize that they can no longer afford to keep making that dividend payment. The value of the stock is going to decrease. So the quintile that has those highest yielding stocks in it is going to suffer, some number of them that have to cut or eliminate their dividend, causing the stock price to come down. That drags down the return from the whole quintile. So it's actually safer to be in the next lower quintile, which is the second quintile of stocks. You can see that right here in the chart that shows that the first quintile payout ratio was 74%, whereas in the second quintile, it was only 41%. So those really high percentage payouts are hard to sustain. Flipping to the next chart, this is through the lens of the dividend policy. So this one isn't dividing up all the 500 into quintiles. This one is simply saying, well, which stocks had a dividend that was growing or initiated a dividend? which stocks had no change in dividend policy over the period, which stocks had no dividend at all, and which ones had a dividend but had to cut it, meaning reduce it, or eliminate it altogether. So the dividend growers and initiators had the highest return of 10.7%. It didn't move as much as the market when the market moved up and down, and it had the lowest level of variation compared to the S&P 500 index at 8.2% return and a standard deviation of 18%. Now, what's interesting is look at the dividend growers and initiators compared to the no change in dividend policy. They just had a dividend and it just didn't change over time. That had a lower return. So this kind of goes to the point, which is when a company increases their dividend, the stock price tends to go up. And you see that in a higher return. And look at the companies that didn't pay a dividend. They only had a 4.8% return. And it was a lot more variable. 22% is the standard deviation. Why? Because everything's hinging on the future expectations of how the company will perform. And then last of all, the ones with the worst performance are companies that were paying a dividend and then had to either reduce it or eliminate it. So again, great article. Definitely take a look at it. There's also a book called What Works on Wall Street by James O'Shaughnessy. It's been out for a while now, and I think it's up to the 5th edition. I'll link to it in the show description. Now, what he did is he analyzed loads of different quantitative strategies over many, many years to see how they compared to the market return. And just looking at the dividend strategy, so this isn't the best strategy that he found overall, but just looking at his findings on a dividend-based strategy, he found that the 50 highest dividend yielding large stocks, and he decided to exclude utilities in his analysis, they had the highest Sharpe ratio of 49, a compound return from 1954 to 1994, so over a 40-year period, of 12.7% and a standard deviation of 17%. Well, compared to all large stocks, that had a Sharpe ratio of 41, a return of 11%, and a standard deviation of 15.9%. And then that compares to the all stocks portfolio that had a compound return of 12.5 and a standard deviation of almost 20%. So that put it with a Sharpe ratio of 43 in the middle. So consistent results with the Hartford Funds study. So what do we learn from this? I'm going to make an analogy for a second. If you're familiar with sailing, this will make perfect sense to you. A sailboat has water in the middle, and they've got a keel underneath and a tall sail sticking up on top. So it pivots around the water level. The keel underneath is the ballast. In a strong blowing wind, the boat wants to tip, but the keel keeps it going from too far over. If there's no keel, if there's no ballast underneath that point, the boat will just flop, it'll flop straight over. A dividend is a keel to your portfolio. It provides ballast. You're getting that payment year after year after year, even if the market is turbulent and going up and down. And what's nice about it is because you're getting that payment, you can reinvest it. You can dollar cost average back into that stock, that portfolio, or wherever you wish to put it. Let's recap then. A portfolio of stocks with a high but healthy dividend tends to outperform the market. Now all we need to find is a portfolio consisting of those stocks. One other thing that we didn't discuss in this video, but in my video, How to Invest for Beginners, it's covered there. It's always important to remember that it's far safer to go with a whole portfolio of stocks, maybe an index fund, versus just trying to individually pick a couple stocks that we might think will outperform. Because more often than not, as individuals attempting to pick stocks, and even professionals attempting to pick stocks, we don't do as well as the market. Now, where do we find such a portfolio? You could do your own stock screening and pick a whole bunch of stocks, a large number that meets these qualifications, but it's a lot easier to buy a mutual fund or an ETF that has already done that for us. Both of those are investment vehicles where somebody has already picked a large number, in this case of stocks, and bundled them together in one single investment. So instead of having to buy 50 or 100 or 200 different stocks, we can simply buy shares in the portfolio that already owns the stocks. You could get a mutual fund or you could get an ETF. An ETF stands for Exchange Traded Fund. So what we're going to do now is we're going to shift gears and look at some ETFs that could be of interest to dividend investors. Now I want to show you some tools that I found that I think you'll find very helpful for screening and evaluating dividend ETFs. And I'd like to make a recommendation of a fund for you to at least look at. I'm not suggesting you buy it, but it seems to meet the criteria that we've unearthed through today's analysis. So into the screen share. Okay, the first tool I want to share with you is called etfdb.com. Now, I don't get paid anything for this, but I just wanted to share it with you. It's a tool that I came across. You can sign up for a membership or use it for free. I actually got a lot out of it just using it for free. Without logging in or any of that, I'm just going to go to Tools up at the top menu right here, and I'll go to ETF Screener, and it starts pulling up a list of ETFs here. I'm going to narrow this down. It's listing 3,026 ETFs, and you can narrow it down by all sorts of attributes. So the ones I'm going to use here for today, first I'll go to asset class, and I'm going to pick equity. You can then go down to a region here, select a region. I'll just scroll to the bottom, and there's United States, North America, Canada, US. I'll pick US. And you can see that has 1,165 equity ETFs. And then I'm going to go to an investment style down here and scroll through that and pick dividend. And you can see there's 83 dividend, equity US ETFs. And now just at the bottom of the page, you can tab through 4 pages. There's 25 per page, so tab 1, 2, and 3 each have 25, and then the 4th tab here has 8 more to give you the 83 in total. Now, if you wanted to further skinny that down, I'll have to see which one it was. Yeah, right here. Under equity again, you can select a size. So if for some reason you wanted to just go with large cap equity ETFs, you can see there's 39 of them. So out of the 83, there's 39 large cap, 5 micro, 2 mid, 32 multi cap, and a small cap. So we can just narrow it down a little bit and just say, all right, well, let's just look at large and multi-cap. And that would be the ones we want to see. So you can see there's 39 and 32. So that would be 71 total large and multi-cap funds to choose from. So that is one tool that's pretty handy. It's got these different categories that you can look at across the top. So right here, you can see the symbol, the ETF name, assets in the ETF. You can see the some year-to-date figures. You can see returns for the different funds, 1 month, year-to-date, 1, 3, 5 years. You can see dividends. For example, this one here is a $2.55 annual dividend. But you can also see frequency. So if you're interested in finding something that pays out, quarterly or monthly, I think there's a few monthlies. Most of them are quarterly. And again, you can see what the annual yield is. This was the dollar amount per share that you own, but this is the dividend yield here. And there's a little bit of info here on risk. They tell you the average PE ratio in the fund, the variation, how much it has varied historically. That's the standard deviation, the ups and downs. This is the beta, how much it moves compared to the underlying index. Remember, 1, it means it moves at pretty much the same as the index. Less than 1, a positive number, but still less than 1 would mean it's moving less than the index, less variable. And if it's moving, if the beta is more than 1, then it's moving more than the index. So you can see some volatility figures there. Also some info on taxes and other things. So lots of things. You can use this and get a list. And if you want, you can't download it as a free version, but you can do this. I highlighted it. You can copy it like this just by dragging across it if you cared to really mess around with it. And then you could do, edit, copy off the menu, and then go into a spreadsheet and just do edit, paste, and it'll plop the table down into cells in the spreadsheet. So then you can capture data and just dump it in that way. It's more work, but you can do it. Now, there's other info that would be really handy to use. So I like to then go over to Yahoo Finance. And in Yahoo Finance, okay, then you can search for the ticker up here and get more information. So now let's take a look at the fund that I came across that I liked. The ticker is SDOG, the Alps Sector Dividend Dogs ETF. So let's start here. We're going to first sort. You can sort by clicking on any of the column heads. So we'll just go back to the overview. And let's click. Well, let's do name. That's the quickest way because it's an A. I'll click it a second time. It'll go back to right there. So right here, SDOG, Alps Sector Dividend Dogs ETF. We're going to go over to Yahoo. Going to look up SDOG. Right there, Alps Sector Dividend Dogs ETF. And here you can get holdings. So you can see what equities it owns. And so from looking at this, you can see that it's in 99.75% in stocks. You can see the sector weightings, basic materials, consumer, financial, real estate. It's got no real estate, and it's got about 10% in utilities. So I point those out because if you've watched my other video about the real estate sector, that one's really focused more on housing, but it looks pretty highly valued, and it looks like real estate is going to come down potentially quite a bit in value. So the other thing that concerns me about real estate is after COVID, a lot of the office buildings have continued to be at greatly reduced occupancy. So at some point, either the people need to start going back into the buildings, or you got to think the real estate sector is going to be in trouble with all that empty space that's not getting used. So I know I'm not that big on trying to second guess and choose sectors, but real estate is one I'd be inclined to avoid. But that's it. I'm not worried about anything else. And I like utilities because utilities tend to be steady payers. And with the shift of the U.S. to more and more electric vehicles, we're going to need utilities to invest more and grow their electric production, which to me means they're probably going to be making more money in the future. So I like this one. Do your own research, make your own conclusions, but I like it not having real estate and having some amount of utilities. In terms of other factors to consider, it's got a PE of 12, price to book of 2.4. Again, these are just averages for the portfolio. Price to sales of 1.1, cash flow, price to 9. So you can see some things like this if you're more interested in digging in. And then the other one to take a look at is risk. We talked about the Sharpe ratio. You can see here the Sharpe ratio for 3 years, 5 years, and 10-year periods, because every time you measure it, it's going to be different. So last thing I want to share with you, the spreadsheet where I've captured some data using a combination of the ETFDB and Yahoo Finance on a few different funds that I came across. And here's the SDOG. So you can see by pulling some information from different funds into one spot, you can have a little bit more info all in one place to be able to compare different funds against each other. So the asset category, according to the ETFDB, this fund is large cap value. It's US large cap. It's got 1.2 billion of assets. These figures were mid-November when I was initially doing the research. You can see the yield at the time was about 3.37%, paid out quarterly. had a 0.4% expense ratio, so not dirt cheap, but not awfully expensive. And then here's the return at that point in time for various time periods. So year to date, 3-year, 5-year. So negative 1%, 26%. Now remember, this is negative 1% when last year the overall market was down quite a bit. So this was year to date 2022, and this fund was only down 1%. The 3-year return was 26%, and the 5-year was 41%. And here's that Sharpe ratio again of 2.85, pretty good. It has 52 holdings, and I pulled some asset concentration info out of Yahoo Finance. You can see 23% was in the top 10 assets. And here's the breakout, 10% utilities, no real estate. And then in terms of distribution among the market cap of stocks was 81% large, 19% mid cap. I just thought this one looked interesting after the review of the things that make dividend funds go. So I think that's a good place to wrap up for today. We've covered a lot of ground. There's a very interesting study and a book, the O'Shaughnessy book. I'll link to them both in the description below the video. Take a look at my other video, How to Invest for Beginners. It lays out a very simple framework in which you can invest confidently in time-proven strategies that will beat the market without stressing you out. Until next time, I hope you have a great day. See you soon.